Hello, everyone. Welcome to this webinar in the series on fintech that CGAP has been hosting. This webinar today is particularly focused on funding, especially funding that can create impact in the world of low-income communities. We know that this is going to be a pretty pertinent topic today, given the market environment, and I'm really excited to present to you a very esteemed esteemed set of panelists that we have today. Let me first tell you about myself. My name is Gayatri Murthy. I am a financial sector specialist here at CGAP. So we're a big team of people who've worked here on fintech, and my specialty has been on trying to understand the connection between these business models that are emerging and the impact potential we can have. On the panel with me today, I'm really proud to say, are three funders who work at very different angles and different parts of the funding ecosystem and bring really diverse lessons that we hope together can present a pretty vivid picture. So first we have Amee Parbhoo, who is a managing partner at Accion Venture Labs. Accion is, as many of you may know, a seed stage impact investment initiative and focuses on fintech, particularly for the underserved. Alongside her is Bart van Liebergen, who is a senior strategy officer at FMO, where he advises financial institutions group at FMO, which is on how to think about the strategy for fintech. Many of you may know, but FMO is the development finance institution for the Netherlands. Finally, with them is Sandeep Kaujalgi, who is a SVP at Bharat Inclusion Initiative at the CIEE.co, which is situated within IIM Ahmedabad. He oversees several, I think, initiatives and projects on incubation and advising fintechs, but particularly today, the Bharat Inclusion Initiative that he represents is also early stage kind of incubator that takes him into the world of fintech, but fintech at a stage where there's a lot of technical advice, building up business models, and really firming up their market access strategies. So it'll be very interesting to see how each of them sees this space. Let me set the context then about what the conversation will be about today. CGAP began to look at fintech several years ago, but about 2 years ago, we thought it was really important to understand what was happening with investment and funding and whether the development flows were connecting to impact. But before I talk a little bit about our work, I think it's pertinent to acknowledge what Amee in our conversation called the elephant in the room, which is the funding climate today. We're looking at several macro risks and looking at a pretty uncertain few months ahead of us. And the key reason for that is the various events in the world, ranging from the pandemic to the recent war in Ukraine and several small and big climate shocks being faced around the world that affects prices. This crisis is complicated and will affect fintech investing in various ways. For one, there is going to be a shortage of capital and capital deployment. We can expect that the fintechs that are in consideration for funding will be dealing with low valuations of their company, potentially lower deal sizes, and overall fewer deals and an environment of deep conservatism. This probably affects us in the financial inclusion space even more. So we're probably going to see a disproportionate impact on companies in emerging markets, and more so fintech companies that are coming up with unusual or harder to prove business models. And that kind of often connects with models related to low-income communities. So it's important that we pay attention to that. Overall, the risks are so macroscopic that we can't forget that they'll also have an impact on the customer base of many of these fintechs. So we're talking about a massive impact on low-income communities and their livelihoods, which really impacts the businesses that these fintechs will be in. This has been a conversation that's been happening for several months now, and funders around the world are asking their portfolio companies to really look ahead to an uncertain time. But even before the pandemic times, I think to set this conversation up, it's important to remember that we've been in a period of rapid rise and continued rise in fintech investing by development funders. So as the figures here show, the development funding provided between 2008 to 2019 was over $1.7 billion. This is an imperfect number in many ways. We don't really know if this is the full truth because the funding sources are not fully available to us. And so CGAP did a comprehensive look at what numbers were available. And these are based on, to a large extent, surveys that we run with a large sector of development funders, as well as other market data available through partners that we worked with. So this is the best guess we can have as an industry. This represents a kind of singular number, but it's important to know the number has been rising and largely driven by large development finance institutions. Most of this money went kind of directly or indirectly to the fintechs. When I say indirectly, I mean through funds. But overall, what's kind of obvious is that not too much funding goes to the market and market development. So this would mean funding for whether creating local investment environments, funding for policy infrastructure change, those kinds of things we've seen less participation in, and we think important to call out. Even in these pre-pandemic times, I think the 3 or 4 things that I wish to highlight for this conversation and love to hear the panel speak about is whether we think what else is needed to ensure funding reaches the full spectrum of fintechs. A lot of funding gets concentrated on kind of a few business models that we know much more about and that have proven themselves to some extent, whereas funding for early stage is particularly scarce. I think the instruments then to support these early stage models are also kind of less understood. For instance, what is the nature of patient capital when we go into models like insurance, savings, and when we are working in situations where there are hard to reach populations or key digital financial infrastructure is missing. Another key aspect of what we saw in the data is that funding is concentrated in markets where this digital financial infrastructure is present or has developed recently. So where there are markets, where there are infrastructure developments like markets in India, in Mexico, in Indonesia, you see a real flourishing of fintech and a real flourishing of capital. And the danger there is we not only risk kind of digital divides of populations, but even a digital divide between markets, where over time, some markets develop profoundly, and the gap also gets pretty significant between a market that doesn't have the basic tools, basic infrastructure needed to kind of really set fintech off and set these startups up well. Finally, there's limited evidence on how all of this funding comes together. So I really want to try to understand that with my panel and their thoughts on it, on when there are various actors kind of funding at various levels, how can we as a community of funders think about this more collaboratively and what might be the complements we're looking for, especially when we're looking at our effects across both development funding and the goals we have to complement commercial funding. Finally, I'll end by saying that the next phase of fintech, though, even with some of these risks that I mentioned earlier, is a period of profound risk, but there's also very significant opportunity to think about that potentially in the time leading up to the pandemic and continuing, that there has actually been a furthering of digitization, whether it is increased access to smartphones or kind of forced transformations that the pandemic brought about. I think recent kind of visits to the market. I'm coming actually to this webinar from Kampala today, where we've been looking at various business models in Kampala and in Nairobi. And I think one thing that really stands out, that a lot of informal work and small businesses are being exposed to a kind of digitization that we should track. This is not only about platforms, but a whole host of digitization that's happening, which gives, I think, more opportunity for embedded finance that I'm sure my panel will have thoughts around. And so there are opportunities here that, if done right, can really unlock inclusive finance for these new types of customers. I think a key risk, though, is ensuring that the regulations and policies that support fintech keep up with this messy transformation in place. So not only making sure that the digital infrastructure exists, but that the regulations that come about remain safe, however, encourage the new kinds of models coming up, whether those are, bundle services, whether those are models that leverage embedded finance and need certain policies and in place to function. So I think this issue of funder coordination becomes even more imperative, because there is the leveraging of this opportunity will involve us all looking at the problems in the market together. So with that, I think I will now unshare my screen and ask my colleague Daniel to set the panel up. Just give it a second. And while Daniel is doing that, I think one thought is that if you have questions that come up while we're speaking, either about something I said or something that the panel said, please do put them on the chat. And I have a colleague who will be tracking them, and I can bring them up within the conversation as well. Great, thank you. So as I said, we're lucky here to have a panel that's made up of funders operating in different aspects and different parts of funding. So very happy to welcome Bart, Sandeep, and Amee. Thank you for joining us today. I think let me set up the first question here, and just the way things will go is I'll ask about 3 questions to the panel and go around the table for responses. I'm sure there could be some follow-ups and cross responses too. And then we'll have a designated amount of time for audience Q&A as well. But keep your questions coming. We'll be tracking them as well in behind the scenes. So let me start with a kind of general opening question to Bart first. Maybe each of you could tell me a little bit about what your kind of funding strategy has been so far. What have you been doing with a particular focus on your investment goals and your impact goals? And like I said, there is an elephant in the room of where we stand today with the difficult market. So if you wanted to comment on that and what that means for you, please do that as well. So over to Bart first.
Yeah. Thank you, Gayatri, for having us and for the insightful presentation, and indeed happy to comment on FMO's experiences so far. So at FMO, we've been in the market since 2015. First, kind of tiptoeing in with a couple of fund investments, and then pretty quickly we realized that we needed our own kind of VC capabilities at FMO to be active in the market. So we set up a venture capital team with a funding structure behind it, where we would fund not only from our own balance sheet, but also with public funds and with a guarantee from the European Union. So that gave us the risk appetite to be active in the field. So since then, we've invested about $175 million in about 40 transactions and to 20 fintechs. So what are the models we invested in? I do recognize what you say. So what you see at FMO as well, there's been a concentration in lending models and payments models. Those are close to our traditional mandate of investing through FI. So that's of course where we started out. I apologize. I hope you don't hear an alarm sound blaring outside, but there seems to be a motorcycle.
Like it's very faint, so I think we can keep going. It's not unusual.
Okay.
Yeah. And I think it's going away now. Yeah.
Yeah. Okay. Good. Yeah. So, and we've moved then also a little bit more into different models, software as a service, embedded finance. We've had one investment in Apollo Agriculture in Kenya, where financing is combined with other inputs for smallholders. So we're going into different models as well. If you look at our impact goals, so FMO is a private sector development bank. So typically our impact goal in the FI, financial institutions field has been around ensuring financial inclusion for MSMEs. And we've measured that through, jobs supported, loans, volumes issued, etc. Of course, with fintech, that's very different. There's a plethora of models. You cannot track impact using these models because of, or using these indicators because the models are different, but also because the scale is lacking. So basically, our goals here are really, you want to validate models, to see what works, what are critical conditions for successful financial inclusion impact. What are risks, not only prudential, but also on the consumer protection side. And I think, one of the goals also implicitly has been, we want to create challengers to the status quo. I think the financial services sector in a lot of countries has been relatively stable over the years. Costs of intermediation remain relatively high, not everywhere, but certainly in some places. And underserved populations remain hard to reach. So what you want to do is create challengers that make sure that market, or that show that underserved segments are also interesting for incumbent. Overall, our role really we see our role as focusing on those inclusive business models, the ones that are really targeting the underserved client segments of women, youth, rural populations, and where we take a kind of long-term relationship with a client. So we're not working on kind of opportunistic one-time transactions, but more serving a client through the life cycle, basically, with VC, debt, different products over time. I can say a little bit about our experiences, but would you like me to go on with that, or would you like to go to some of the other panelists?
Yeah, maybe I'll come back in the next question about your lessons that you've learned as well. And I think it's great to have you on the panel, because FMO has been really on the has done fintech investing quite longitudinally over time, and has quite a long record of participating in fintech. So your lessons will be important. Let me switch to Amee now. I think Amee, Accion Venture Labs really has been a trailblazer in figuring out what these new business models are, and really educating us about them through your work. So I'd be really curious to hear how you've seen the role Accion Venture Labs has played, and maybe a little bit about how you're feeling today about the environment as well. So over to you.
Yeah, absolutely. Well, thank you, Gayatri and CGAP, for having me. Excited for this conversation. Yeah, Accion Venture Lab has been in this space for the last decade. We've been investing. We are a seed first impact investor. So we're investing initially kind of pre-Series A in companies, typically as the first institutional investor into those rounds. So we come in fairly early, and then we grow with our companies. And so to your point, our value and what we see our role is sort of coming in early as the company is first developing its model and building its path to scale, and then actually helping that company successfully scale. So again, investing for the last decade, we've made around 60 investments to date around the globe. So our companies are working in, I think it's 39 countries now around the world. And I think that's really where we see a lot of the value we bring, and also the learnings is from, bringing what's happening in one side of the world to another, sharing those learnings, sharing what's working, what isn't, so that entrepreneurs can learn from that and improve what they're doing. Our focus is not just on inclusion. I mean, really the way we think about our impact thesis is we believe that bringing well-designed, affordable, responsible financial services is going to help the underserved, low-income consumers and small businesses grow and prosper. So financial services are a means to that end. And so our focus and our investment thesis spans across financial services, from payments to credit to insurance, all of the products that you need to kind of have that healthy toolkit for the future. But I think more and more what we're seeing is a blurring of lines, and we'll talk a little bit more about this, but a blurring of lines of who is providing financial services, how these products are kind of created and designed and distributed to the populations we care about. And so we're really excited about those kind of spaces around embedded finance, as you mentioned, but also intersection points between fintech and agriculture or education or health tech. Those type of companies are adding immense value. We know that those other sectors require affordable solutions, and that's where fintech can come in and play a role. So that's kind of a key part of our investment thesis. The last thing I would say about our approach and also our impact thesis is obviously we care about the reach of our portfolio companies, how many customers they're serving, the quality of the services that they're providing. Those are the things that we track. But we also, as a fund, have kind of in our DNA a focus on catalyzing the broader industry. And so we have what we call a capital plus approach. In addition to the money we provide our companies, we're doing two things. One, we're providing active support to those companies post-investment through an in-house consulting team that works with them on their key strategic issues. But we're also doing a lot of work in the industry to share our learnings, to say, it's not just about the 60 companies we've invested in and the impact they can have, but how do we kind of translate that to others so that they can have those learnings and have a similar impact in the future. And then your last point, just on the kind of market environment, this is top of mind for all of us on our team, as I'm sure it is for all other funders. In some ways, it feels, I was talking to another investor yesterday, it feels like we're back to the beginning of the pandemic, where it's sort of everyone saying, okay, let's plan for, the next 18 months, 24 months, what it could look like. And so, I think these next several months are going to be challenging times as companies think about the runway they have, the capital they need to raise, the terms that they get from investors. I think there's a lot of focus on valuation and will there be more down rounds, but I think there's also just the return of different types of terms that are not as founder friendly. So I think there's going to be more education to be done for founders who aren't familiar with this kind of a world, which we haven't been in for the last few years. And there's a real focus for us as funders of how can we support the models that we know are most vulnerable because they're supporting in emerging markets and supporting the most underserved populations. How do we make sure that they survive through a difficult funding time? So love to hear everyone else's thoughts on that, but I think that is very much top of mind for us.
Yeah, absolutely. And with that, I think, Sandeep, it would be great to understand Bharat Inclusion Initiative's kind of work, but also I think to foreground, the fact that you are situated in India, and so you have a very kind of deep local view of what's happening in one market. Of course, one of the largest markets on earth by any stretch, but still it'd be really nice to understand the work you've been doing with BII and how the work that you do at that stage, which is very early, is very specific. You're looking at lots of great new ideas, but the work there perhaps is to clarify which ones are worth supporting. And so I'd be really curious to hear about BII and what the kind of work you've been doing, and definitely how you're feeling in India about the recent risks that present itself to all of us. So over to you, Sandeep.
Great, thanks a lot, Gayatri. Glad to be here and present our view to all of you. I'll go to the mothership, right? The CICO as an organization. We've been here for more than a decade and have been supporting early stage entrepreneurs for, across sectors. And in some sense, our work on financial inclusion in some sense, started a few years ago, around 4 to 5 years ago, with the Bharat Inclusion Initiative, where we got together a set of marquee funders like the Gates Foundation, the Dell Foundation, JP Morgan, MetLife, to just come together and explore how startups can actually improve financial inclusion in India through technology. Now, that was a time when what we call as the jam trinity in India was actually coming up. We have the Jan Dhan, the bank accounts were open. You have the Aadhaar, which was suddenly enabling people to get on board and was actually making it quite cheaper, to get the customers onboarded on the digital financial inclusion bandwagon. And then you had the mobile, broadband, where we saw a huge increase in the adoption. And this essentially was the catalyst that, was, that was essentially the, the factors that led to and undeniably an increase in adoption. But so far, we have seen the adoption mostly happening in, again, lending and payment solution. Now, where we work at this very early stage, startups don't just need patient capital, but additionally, they need a variety of other support, right? Because they're still just even validating their products, their business, the value proposition that they have for their customers. And which is where we felt, when we are looking to fund startups or support startups, it's not just some patient capital, including grant capital that we offer, but also a variety of other support, including even assisted field studies that we offer to the startups to help them actually understand how the customers are thinking. Most of the entrepreneurs, just like investors, they come from my view that that their customers don't belong, right? And which means that that intuitive understanding might often lead them to the wrong path. And we begin our interventions right from that stage, and then take them on, through a journey. We call it our continuum, in a sense, to a place where we can find product market fit. And while this is on the individual startups, as a program as a whole, the Bharat Inclusion Initiative is very much focused on a use case approach. And a use case approach enables us to support multiple solutions that are looking to solve a specific problem in a different way. Just to give you an example, in India, we have Roscas. They are known as chit funds in India, and they are, a lot of people in the lower income communities actually use them, but more in an offline manner. So we, as we were looking for startups to support and the ideas that we wanted to support, we found these startups who are looking to bring these Roscas online. And in a way, what we did was that we worked with at least a few of those startups. In some sense, we have crowdsourced the idea from these startups, but we worked with them to make these Roscas, safer for these communities, to make them more transparent and to make them more rewarding, right? So this was one approach, a crowdsourcing approach that we followed. The other approach that we have followed is, right from taking ideas that are in research, for example, to finally becoming a product. So example, let's say we looked at a digitally delivered mutual insurance model. For example, it started off as a research within the Bharat Inclusion Initiative and has now gone on to start a pilot with some truck drivers in Mumbai. Right? So in some sense, the approach that we have taken, has been to essentially look at different ways in which we can find interesting ideas. Another consideration, I think, which Bart also referred to, in a sense, was to be considerate towards the use cases and towards solutions that have already not seen maturity. Now, when you go out and start finding startups, you'll see that a lot of promising startups are typically in the lending space, in the payment space. Maybe some have reached some maturity. So we need to make a conscious effort to find out those startups, startups in the savings space, in the insurance space, in the fintech enabler kind of space, so that we can actually able to help them at this early stage, and then in some sense make them more investable. Yeah, that I'll stop there.
Great. I think another question that I'm sure a lot of people have in mind with you as panelists is to understand the lessons you have learned. Particularly, I think CGAP's work, the research we've done with funders like you shows, there's a lot of challenges that you encounter in realizing the impact vision you may have, whether it is about the marriage between impact and scale, or the difference between seeking growth versus sustainability. I think the issue of matching the needs of the fintech with the right instruments. There are a fair amount of challenges, and they may apply more to one type of funder than the other. So I think starting with Amee, I'd be curious to hear about kind of the major challenges that you've faced in realizing your vision, and whether those challenges have also changed in the time that you've been doing this work. So curious to hear what you think about that.
Yeah, it's a great question. I mean, I think for us, especially coming in as early as we do, we're taking early bets, and we're taking, we're willing to take risks on innovative new business models, as my panelist has talked about, and to take, risks on markets where, we maybe aren't seeing yet unicorns that have emerged. And so I think it's a willingness to sort of really learn about what are the broader trends that are working in different markets, and coupling that with then, deep research on a local market. So coupling kind of global learnings with what's happening on the ground that helps. And I think that's something we continue to push ourselves to do, because we don't want to necessarily just be a fund that's focused in, the top 5 markets where everyone is focused. But we also want to make sure that we're achieving our investment and impact goals. The other piece I would say, and this again goes back a little bit to the market environment now, so it's very top of mind for us, is how do we continue to move toward models that are both scalable but sustainable? And this is a challenge I think you're hearing more and more investors talk about today, of saying, oh, we're not looking at growth metrics alone anymore. It's not growth at all costs. We want to see profitability. We care about unit economics. We want to see the fundamentals of the business model. Well, that's something we've always focused on, and we've always wanted to see. And that's a challenging balance for companies that are, especially early on. We aren't expecting profitability in the first year, but a path to how you get there in the medium term. And for early companies, they're, again, just figuring out, okay, how are they getting to market? What's the go-to-market strategy look like? Coupling that with also, how do you think about retention? What's your lifetime value for your customer? What does the broader product roadmap look like that would help you achieve that? Those are all the set of questions that we think are also quite interesting and important, not just from an investment perspective and from a long-term sustainability of the business model, but from an impact perspective, because we care about the value to that end customer. And it isn't valuable if it's a company that is coming in and providing, signing up a customer, maybe having them use the product once or twice, but then churning fairly quickly. And what's that broader set of values? So we've done a lot of research and work with our companies around what we call kind of winning from within. What are the ways in which you can bring value to your existing customers, whether that's by building a graduation pathway for them of new products, expanding the suite of offerings that you have, thinking about ways in which you drive repeat usage. And I think that's a really important topic, but also challenge for fintech companies, especially when you're surrounded by a lot of companies raising a lot of money that, are driving for growth over anything else.
Yeah, I think with that, it would be interesting to contrast that with Bart's experience of working with the DFI, generally investing at a much later stage, but increasingly being exposed to a lot of the new innovation, and perhaps having to think about how do you kind of go downstream and still kind of be beholden to the responsibilities of being a DFI and proving to be secure with public funds. So I think just curious to hear how you see the challenges, especially I think since you've been involved in a strategy thinking for FMO, how does FMO see the challenges it's faced and kind of possibilities of solving them?
Yeah. Thanks, Gayatri. And indeed, I mean, we come in typically a little later than Amee and Accion do, but still, I think at an early stage, I think what we see in our VC portfolio is just also investing in these companies is a highly intensive, small scale business. So the ticket sizes are typically quite small, despite the valuation bonanza we've seen. We've also really done some smaller tickets. And you just see that there, with a company at that stage, there are just so many issues still in terms of, corporate governance, stability of funding. So what you see is that our investment officers are just really, if you have at some point a sizable portfolio, it just puts a lot of capacity on the investment officers, the associate portfolio managers. So I think that's something that we're really struggling with. How do you at the same time you want to keep investing, want to keep having that pipeline of new transactions coming in, trying out new business models, and at the same time the existing portfolio requires a lot of stewardship, corporate governance, capacity development initiatives that we do with them. So that is certainly an issue. And that's, of course, even before, any market turmoil that might be ahead in the coming months. So we'll definitely see how our VC team will be tested. I think what we learned as well is that, we've been, in terms of risk appetite, I think the fact that we were able to move our investments kind of partly off balance sheet has helped us a lot in having appropriate risk appetite and also retaining it. And that is something that has really helped us. At the same time, if you look at a product suite, I think we certainly still have some gaps. So what we see is if we want to serve fintechs over a longer period, we have quite some different products in our portfolio, debt, equity. We have portfolio guarantees that we are also now where we are linking local banks to local fintechs to make sure that there's local funding for fintechs. But there are certainly also gaps, especially at the earlier stage. A lot of fintechs need working capital, revolving lines, factoring, and that's something that we do not have at this moment. So that is a strategic question for us. Should we go into those product areas? And the last one, I think, is as a DFI, you're not always the fastest. So that is something, the speed of processes, the speed of disbursement, etc., is something that we had to adjust to. So especially for our VC program, we set up a separate credit process that is kind of fast track compared to overall credit processes. So it's been a kind of a learning journey, really, to adapt to the circumstances and the needs of the fintech market. I think the last one challenge for us is what you see is that a lot of models blend with consumer finance. So if you have a payments firm, it's very often attractive for them to go into consumer finance. And that is a segment that also comes with some risks, as we've seen over the past years on the consumer protection side. So how do you manage that? What is our appetite for consumer risk? We do have some, or for consumer finance. We do have some appetite for it, but it's certainly something that we watch closely and that we need to manage and monitor. So let me stop there.
Yeah, that's interesting. Sandeep, I think, again, a unique space for you is because of the stage you're in, you're probably looking at companies pivoting, changing what they want to do, making sure that that happens in a kind of sensible way is probably a big part of your work. So curious to see what challenges you've faced, and it could also relate to potentially, moving these companies along. How hard has that been? And just a quick note to say that I see the questions coming up in the chat, and I'm kind of collating them on the side, so we're going to get to them very shortly. But over to you, Sandeep, on how the challenges have played out for BII.
Yeah, great. Thanks, Gayatri. So ultimately, the underlying belief is that tomorrow, if we want the startup to create impact, it must really survive, right? And to survive, it must build the model so that it's sustainable. And what we've also understand is that when it comes to some very early stage startups, most of them are likely to fail eventually down the line. And somewhere we have to be comfortable with that. And that, I think it is with this belief that we typically go on to help the startups. And we do build in some kind of commitment from the startups, even right from the selection itself. We do explore how interested the startup is when it comes to serving the lower income communities, right? I think that's extremely important. Do they come from that background? Do they have understanding of the space? Has there been something that's happened in the life that's actually motivating them to do? Somewhere these points are important when it comes to supporting the right kind of startups. When it comes to pivoting, luckily for us, the portfolio that we have seen, more or less the startups have, they've continued working with the segments that are of interest for us. In some cases, yes, people might have looked to pivot, but probably just one step away. Because in fact, all the support that we provide is also very much targeted at helping them serve this lower income segment, right? So in some sense, while the challenge of survival is always, it's hanging up above the startup's head in that sense, but we have also seen that passionate founders who are focused on building sustainable businesses are able to withstand that. And that's wherever we have seen some kind of challenge coming in. To give you an example, again, when it comes to lending startups, in India, ultimately the lending startups have to partner with a regulated lender who will actually be giving out the loan to these startups. And the fintechs typically have to provide a guarantee fund. They have to place it with that non-banking, the financing company. Initially, the founders are able to do it out of their own personal savings, right? They are the ones who fund it. But after that, beyond a certain point, where the investors or the lenders have probably not are not completely convinced about the model to completely remove that for default guarantee, but at the same time they also need to grow, and there is a lack of capital especially at that stage, where one level of validation has been achieved, but there's a lot more that is needed. So what we did in that case is we worked with another philanthropic organization. And we got some supports which was specifically targeted at providing this default guarantee for these startups. It's something unique that we have done in the Indian market. Unfortunately, that capital is also limited, which means that we have to select the startups that will get the support. Still early, but we have seen some encouraging signs that is essentially helping them, almost double or triple their AUMs, for example. And we believe that as they grow further, they'll get that validation so that more investor money can come in. Right. So really, the biggest challenge, if you go and ask a founder what's the biggest challenge to scale, they'll tell you it's funding. That's our founder's role. Yeah.
Yeah. That's definitely a familiar thing we've heard too. So with the time remaining, I think I want to close with a question, and then I know a couple of audience questions to get to you. But the last question I want to ask you is to just take a minute or two and tell me, Amee, you mentioned an uncertain 18 months ahead. So have you already thought of a strategy for what your 18 months are going to look like? I think there could be opportunities, but the risks are pretty large. So how do you see the next 18 months for the kind of funding you do? Yeah, so maybe I'll start with Bart this time. Bart, what would you say?
To be honest, so I haven't engaged in those conversations, so I wouldn't know. What I can say is, we just went through our fintech kind of strategy process. So we reviewed our strategy after the first one was from 2017. It was time for a review. So I can say a little bit about what we are changing internally, because what we wanted to do with our experience now in the market is really kind of to broaden our proposition. So where we first were centered around venture capital, we also had a couple of selected debt deals. We really wanted to make sure that we have this kind of graduation model approach where we can serve our clients throughout their life cycle. And so where the propositions of each of the FI departments, so debt, equity, VC, are kind of integrated and with capacity development as well. So what we've been really building internally is kind of capabilities to make sure that there's more coordination between the different teams, cooperation. And an important one is really also capturing learnings and sharing learnings across the organization. Where I think typically we previously saw that a lot of those lessons remained within the VC team. We want them to be spread really across the organization. We want the organization to upskill. And a second point is that Amee also mentioned is we don't want to keep those lessons on, what models work, what are the risks we're seeing, how do you work with these institutions at an early stage. You don't want to keep that to yourself, but you want to share it with the market so that you basically contribute to some market creation. So that's something that we've really put in place mechanisms to share those lessons across the organization, but also to share them in due time with the outside world. So that's something that we're currently focused on, and I think that capabilities building we'll be doing in the coming period.
Yeah, that sounds great. And I think something that all DFIs could also learn from. I think there's a lot of value. I think we've seen that a lot, that there was a kind of fintech group within a DFI, and now a lot of the time has come to think about it across the DFI, not just within one team. Amee, what would you say? How do your 18 months ahead look, and kind of what skills and capabilities do you think you'll have to build to get through?
Yeah, I mean, I think it's kind of two-pronged for us. One is, as I said, we're working already hand in hand with our portfolio companies as it is, but especially these next, this next year plus, we will be working with them around funding their fundraise plan, around this path to profitability, and the narrative, the story of how they're working, what they're building. So a very active portfolio management, which is for a team like ours, which is sizable but still small, it takes a lot of time and management. So that's something we'll be focusing a lot on. But the second prong, we aren't going to stop making new investments. And you alluded to this, Gayatri, in your presentation. I mean, this is an incredibly exciting moment, regardless of what's happening in the broader macro environment for fintech. The increase of kind of contextualized solutions, the kind of blurring of lines of who's providing financial services. There are all kinds of open banking, the more kind of recognized need amount among our customers for using digital tools. All of that has driven increased digitization, all kinds of new exciting opportunities for financial products. So in some ways, in the past, we've seen the strongest companies be built during difficult times. And so we want to continue to invest. We'll be doing that thoughtfully in the right way, but we will be continuing to build our pipeline and build our portfolio. I don't expect that to slow down.
And Sandeep?
Yeah, I'll make it quick. So over the last 3 to 4 years, I think some new trends have emerged within India. One would be the rise of India's stack, especially the newer elements of the stack, right? We have the OATC, the account aggregator, OCEN, and the like. And what we have also seen is a very good growth when it comes to the angel and the seed investments that have happened. I think, and I think that is going to remain strong in India. It's from whatever the conversations that I've had, the pain in some sense is mostly in the later stage investments. While for promising solutions, the angel and the seed investments are still going strong. So at least for us, it means that the startups that we are working with have that next round of capital that they're always that's still available for them. The other area that's definitely emerged is digitization, which is more acceptance of digital tools in general by a variety of actors, be it small businesses or individuals. In general, and these three are going to drive, fintech within India, in a sense, and solutions that are built over these. I think they'll always find takers among the investment community, and maybe as the investment scenario improves, we are definitely going to see these solutions scale up tremendously.
Great. So I think we have a few audience questions, and I'm going to try to collate a few of them together since we don't have too much time. And any of you who wish to respond to them, please step in, Amee, Sandeep, and Bart. So one kind of theme that's emerging in some of the questions is people are asking about the kind of setting up of goals that might be contradictory. So in impact goals or investment goals that sometimes don't line up in a easy way. For instance, if you are seeking impact on low-income communities, sometimes that doesn't necessarily intersect well with commercial viability in an easy way, and it's a struggle. And at what point would you want to say that, yes, we were chasing impact, but we'll have to pull the plug on this because the viability is not at all there. On the other hand, if you're pushing too hard for a business model to work, you might run into a kind of risk of not being ethical when it comes to the pricing of products and whether this is the right price and the right conditions in which to offer this to a customer. So, the issues of kind of making sure that these products are responsible products. So just easy question there about how you balance kind of the goals for impact, goals for business, and kind of remaining safe and responsible, and how each of you have kind of dealt with this as a challenge in your work. So any of you who want to answer this, please.
I can start. It's a good question, and yeah, I mean, it's always a balance, and I think you find, impact investors all have different ways in which they do this. They're different kind of, it's a spectrum of who does what. I think for us, we don't view it as a trade-off in the sense our first, screen for any company is an impact screen. So it's saying who is the customer that this company is trying to reach. What is the set of products and the kind of responsible, affordable way in which they're trying to reach that customer with a product, and how do we kind of feel about this team and the kind of mission orientation of the team. if all of that checks out, then we're looking at an investment like any commercial investor would. And so that's kind of our approach to be able to balance those two. But I think the other piece of it, which is important for us, is it doesn't kind of stop once you make that investment decision, right? Especially for those of us that are working at the early stage. A lot of these companies are just in the beginning of figuring out what their model looks like. As Sandeep talked about, there's a lot of pivots that can happen, and that can create impact risk, impact opportunities. And so it has to be a hands-on way in which you're, one, defining an impact thesis that you then track, and you have metrics associated with it so that you can evaluate impact throughout the life of that investment. But you do that in a way where it's sort of aligned with what's valuable for the company. It's not creating an extra burden and an extra load for them. So that's not easy to do, but I think it's both about, how are you screening and thinking about impact in your investment process? And then post-investment, how are you incorporating that into the way you work with these companies and support them going forward?
Yeah, and I think it's broadly the same for FMO. So once when we do an investment, you outline, what is the basic forecast. You outline impact targets to reach by the company, and based on that, basically, we track progress. And if things don't work out that way, I don't think we've seen it yet. So we haven't pulled the plug on any investment yet. So I think it's also, especially the coming 18 months may show, if there's going to be a shakeout or anything, and we may have to make those decisions. But generally, impact is just the first, first metric for us to look at.
So we have 2 minutes left. Let me try to squeeze another question in, unless Sandeep has a response to this, but maybe he has a response to the other question, as you see fit. Another question we have is on whether each of you, what's your view on forward-looking regulation, and whether you've seen in the markets you work with, whether you've seen regulators promoting practices that have been beneficial for you as funders, or you may have seen also other funders around you working with regulation and kind of creating environments that pave the way for you. So either ways, I think just a good sense of how you've seen regulation working or not working for you in various markets. And whether you found any initiatives helpful. Yeah, go ahead, Bart.
I can take that one. So it depends a little bit on the segment that we're active in. So we're now starting with our our private equity team making investments as well. And previously they've stayed out of this market because of its unregulated character, and they would typically only invest in regulated entities. I think we're certainly seeing countries more licenses coming up in different countries, sandboxes, etc. And those things certainly are beneficial to getting kind of comfort as an investor to move into those models also at a later stage than the VC stage, where we have more of a risk appetite. So it certainly helps us. Not in every segment we have an equal risk appetite, and certainly at a later stage, those licenses help us to go in and invest.
Any other thoughts?
Yeah, I mean, just one thing. For example, while there's, we can always, say that the regulator needs to do this or do that. Some steps have definitely been taken. For example, I think the Reserve Bank of India, that's the financial regulator, has set up a Reserve Bank Innovation Hub, right? And while Mumbai is the financial hub, the Reserve Bank Innovation Hub is actually located in Bangalore to make it more accessible to startups. And recently, for example, we partnered with them to do a hackathon sort of an event, and which was focused on fintech solutions for women. So broadly, I mean, when something like this happens, now the challenge is not just about creating solutions for women, but it's also to ensure that there are partners to those solutions who can take it to the market and actually help it get validated. So while generally on funding aspects, regulators can always support, but like Bart said, when sandboxes like these, entities like this actually help in, actually help with programs and initiatives to promote such solutions, I think that also helps.
Great. So we're right at time now, and I just want to thank all of you for having made time for this panel. And I think we really benefited from seeing the funding space from 3 different perspectives and 3 unique perspectives. I wish we had a ton of more time. I know there were a few more questions. I can certainly make a list of them and try to circulate some responses later. Next week's session actually continues this conversation on regulation. So if you, any of you in the panel, in the webinar today have an interest further on that, next week's session focuses on that exact topic of how regulation can be more forward-looking and what are the various kind of experiences so far. So definitely join that one. With that, I would like to say thank you so much to Amee, Sandeep, and Bart for the time, and thank you for your perspectives. I wish each of you well in your work, and looking forward to hearing the lessons you learn the next time we speak. So thank you so much.
Thank you.
Thank you.